Previously in part 1 we covered why the yield for ARCC is so high, currently 10.4% as I record this. Now in part 2 I'll make my bull case for ARCC and my bear case for ARCC, then I'll wrap it up with my investment thesis for it and whether or not I decided to actually buy it. A quick disclaimer, I'm not a financial advisor, I'm just sharing my personal experiences. Always do your own research before investing. If you haven't watched part 1, obviously you should watch that first, and I'll put a link to that in the description. Let's dive straight in, starting with my bull case for ARCC. So here are 3 factors that I think suggest that ARCC is likely to be a good investment. First of all, ARCC is the alpha dog in the pack. If you look at the market value of all the BDCs, ARCC is actually worth roughly double the next largest BDC. Well, as the largest of the group and also with that long history of financial stability that we discussed in the previous video, it allows ARCC to have excellent access to capital. In other words, the ability to borrow money on favorable terms and at lower rates than their competitors. The second factor I like about ARCC is somewhat related to their size, but that's diversification. They have investments currently in about 450 companies. And in the BDC world, 450 companies is a huge number. So if any of those companies were to fail, or if any of the loans to those companies were to default, it would have a relatively small effect, meaning it would affect less than 1% of ARCC's investment portfolio. By the way, as a side note, BDCs tend to take a fairly active role in their investments, which can include things like taking a seat on the board of directors of the companies that they invest in. Let's move on to the third and final point for the bull case for ARCC, which is something that I was very curious about and is also quite timely. And that is interest rates. They're rising. So is that good or bad for ARCC and BDCs in general? ARCC uses leverage, so won't higher interest rates increase their interest expense? Well, yes, that's true. But also ARCC is a lender, and so they have the ability to increase their rates. In fact, rising interest rates will increase ARCC's net interest income. The majority of the debt that they issue is floating rate, which means they have the flexibility to increase their rates and increase, therefore, their profits. That's obviously relevant during the Fed's current tightening cycle. And this was a comment that was quite important and related to that on a recent earnings call. In that recent earnings call, ARC management said this: "We elected to raise the regular quarterly dividend from 43 cents to 48 cents per share because the company is now experiencing a higher level of core earnings, primarily due to the substantial increase in base rates. This increase, the largest quarterly increase in our company's history, is our third increase this year and results in a regular dividend that is 17% higher than our regular quarterly dividend level at the end of 2021. The higher base dividend that we are paying also reflects our positive outlook on our ability to generate this level of core earnings under a variety of interest rate and economic scenarios for the foreseeable future." So rising interest rates, good for profits. Now, I don't have an agenda when it comes to these investments, so I present the bull and the bear case. But before we move on to the bear case, I should mention that a lot of the information that I get in doing the research for these videos comes from the analytical articles in Seeking Alpha, that website that I mentioned earlier. Those articles I find to be a good source of in-depth research, depending on the author. Some are better than others, but each author will make a case for either buying, selling, or holding the investment that they're discussing. For ARCC, there were a lot of articles, I think more than 100. So I just focused on the most recent ones. So let's move on to the bear case then. Here are some factors that suggest that ARCC faces excessive risk. First up is leverage. And for business development companies, that's commonly measured by debt divided by equity. At 1.26, that ratio is above average for ARCC. Now for me, that's not a huge issue, but it is worth noting. They do have a history of managing their debt well and obtaining favorable terms, but it's worth keeping an eye on. And as the chart shows, you can certainly find other BDCs that utilize much less leverage than ARCC. For example, Main, M-A-I-N, has an excellent reputation. Perhaps I'll cover it in another video. And not surprisingly, Maine, with its lower debt ratio, offers a lower yield than ARCC. The second factor in the bear case is the obvious one, I guess, and this applies to all BDCs and frankly everybody, and that is recession. I said earlier that rising interest rates are good for profitability, but if those higher interest rates lead to more defaults, and if the recession in general leads to more defaults or even bankruptcies, that's obviously a negative for ARCC. And last but not least is something I touched on earlier, and that is price. The price of ARCC's stock is volatile, looking at it historically at least. If there's a deep recession, it's likely that the price of ARCC will fall further than the S&P 500. That's what happened in the 2008 recession. Now, that was a particularly bad recession. There was a global financial crisis. Banks were actually failing, and there was a tremendous amount of fear at the bottom of that market that there would be a huge tidal wave of defaults and bankruptcies. So to invest in something like ARCC, you have to have the stomach to withstand this price volatility. Because, for example, if you'd sold ARCC at the very bottom of the trough in 2009, well, that would have been a really bad move. And on the flip side, if you'd bought during those, well, let's face it, they were fearful times, you would have made a killing because the ARCC stock price recovered quite quickly. Now, putting aside all that emotion, and the stock market is to a large extent about greed and fear, if we look at the historical trend in earnings for ARCC, not so volatile. It turned out that the 2008 recession didn't substantially hurt ARCC's investments as much as people feared. Now, before I give you my take on ARCC, a quick note about tax. The income that you receive from BDCs like ARCC is taxed as ordinary income. Now, I won't be providing any tax advice, of course, but as a general rule of thumb, ordinary income can be disadvantageous if you're an American taxpayer and you're in a high tax bracket. But for non-US investors, it's usually less of an issue, and I'll look at taxation for non-US investors in another episode. After researching ARCC, my take is that in the near term, the outlook looks good, so I bought it. Earnings estimates for the next couple of quarters are favorable. They point to growth in income, and ARCC is benefiting, as I mentioned earlier, from higher interest rates. Looking further out, a recession is quite possible, and if that happens, the price of ARC is likely to fall pretty hard. And I accept that, I'm okay with it. If and when that happens, my plan is to just hold, not sell, and get paid to wait. And when I say get paid, I mean the roughly 10% dividend. My overriding thesis on ARCC is that management has proven their ability to navigate through a recession. And the evidence is 2008, which they came through with flying colors. The current CEO, Michael Arrighetti, co-founded ARCC 4 years before the 2008 recession, so this isn't his first rodeo. If the next recession is as bad as 2008, which I don't think it will be, but frankly, who knows, I think then a similar scenario would play out, which means stock price takes a dive, dividends take a small hit, and there's an opportunity to buy more and receive a yield that's actually much higher than 10%. So with that recession on the horizon, it raises the question of timing, whether to buy now or to wait. And my plan is to do both. But let's take a quick look at timing of buying, selling, or holding ARCC. Now, of all the articles I read on ARCC, my favorite by far was a two-part article by Scott Kennedy. Now, his articles are extremely detailed. In fact, I had to read them twice for it all to soak in. It's pretty intense. And covering everything he described in that article would take hours, so I'm not going to do that. But I do want to mention one point that he made about timing. As I mentioned earlier, the price of ARCC and other BDCs for that matter tends over the long term to basically be flat, maybe up slightly. So most of the return comes in the yield, not in price appreciation. Now, in the short term, the price can get quite volatile. So Scott Kennedy's thesis is to juice returns by buying and selling in the short term based on the price to book ratio. So let me quickly explain what that means and how it works. If the price to book ratio is 1, that means that the stock price of ARCC is exactly equal to the book value of the assets that it holds. During bear markets, the stock price of ARC usually falls below its book value. And obviously in bull markets, investors are generally willing to pay a premium for ARCC, which puts the stock price over its book value. Now, it would be logical for over the long term, a BDC to trade at book value, But because ARCC is the alpha dog of the group, if you take out the recession and you take out the pandemic, on average over the long term, ARCC has traded slightly above its book value. Let's say roughly 5% above. So Scott Kennedy's thesis is that the stock price of ARCC over the long term will continue to revert back to that level. Let's call it 1.05 or 5% above its book value. With all that in mind, Scott's approach is to buy ARCC when the price is below 5% premium compared to book value. So on this chart, that would be represented as anytime it's trading below 1.05. And then when the price to book ratio reaches a 15% premium over book value, aka 1.15 on this chart, then sell. And the reasoning there is that at anything over 1.15, it's excessively valued and likely to revert back to 1 or 1.05 at some point in the future. So that plan or set of buying, selling, and holding rules makes a lot of sense to me, and that's what I plan to do over the long term. And in case you're wondering, as I record this, the price to book ratio for ARCC is exactly 1.0, which would put it in the buy zone. So that wraps it up for ARCC. If you want to do a deeper dive, definitely read that 2-part article by Scott Kennedy. You can use my link in the description to sign up for Seeking Alpha. If you do the free version, you'll get limited access to articles and features. And if you do a paid subscription, obviously you get unlimited access. There's a couple of levels, Premium and Pro. For me personally, I find Premium provides everything that I need and Pro is a bit overkill. Well, I hope you enjoyed this new content. More armchair income coming soon. Higher than our regular quarterly dividend.